Hello and welcome to Macro and Market Update. In this month's edition, we focus on the rising US yields, dollar, gold, market impact of tensed geopolitics in Middle East and commodities, finally concluding with our view on economy and market. Then, let's begin. For Indian investors, three global prices should matter a bit more than others: long-term US interest rates, the US dollar's exchange rate, and the price of oil. And one of the most important developments that has happened in the last few months is the sharp rise in US yields. US treasuries have delivered negative returns for 3 years in succession, something that is unheard of. It's been unable to rally even at risk of event like Middle East geopolitics. That does tell you something. One, that those cross-border politics has still not gone to an alarming zone, and second, that something adverse is developing on the US fundamentals. There are few plausible explanations on US macro fundamentals. One is the yields are still feeling the impact of the monetary policy which had gone parabolically loose post-COVID. Second factor is the super high US fiscal deficit, even when the economy sees 6% nominal growth and full employment. Ideally, fiscal policy should work counter-cyclically. Higher deficit means high bond supply, and that is when Fed is shrinking its balance sheet and key EM nations have reduced adding to US treasuries. With an inverted to flat yield curve, private sector demand for duration assets is also likely to stay low. All in all, US yields are rising because there are fundamental challenges in the economy of high fiscal deficit and still above target inflation. And this tells you that even though bonds are oversold, it seems likely that yields could stay high for some more time. Sure, Fed policy makers have recently hinted that the tightening of financial conditions means limited need to raise rates. So the short end, at least for now, seems anchored. But the long end seems likely to continue selling off unless the US economy falls apart and Fed caves in, or the government embraces a more restrained fiscal policy. There is no sign of that as yet. Or the long end goes up further, yield curve turns positive and market moves to the longer end. Hence, for now, the risk on US yield remains. This brings us to the next question, that is dollar and gold. Typically, geopolitical risk works to strengthen the dollar. Yet, dollar was fairly stable in October. Gold was one asset to show some safe haven rise. In fact, oil was also fairly contained. First of all, this suggests that market attaches a lower probability that Israel and Hamas should escalate into a wider Middle Eastern war. All the other players in the region have clear incentives to avoid a broader conflict. This includes Hezbollah, which, although it has fired missiles into Israel-controlled territory, has by and large so far followed an informally established protocol. As a result, the near-term probability of an escalation, which could be severe enough to destabilize global financial markets, driving oil above US $100 per barrel and triggering a major flight to safety, all these risks remain low for now. If at all the risk of escalation gets pronounced, dollar could gain strength and gold could rise further. Hence, in the near term, both these asset classes are supported. But typically, a more pronounced rally in gold can be expected only when Fed shows more imminent signs of easing, which could also trigger some easing in the dollar, reversing the dollar gains. Beyond the near term, we have a bearish outlook on dollar due to deteriorating US fundamentals. Now, talking about commodities. Commodities have been fairly stable in 2023. Few agri items such as coffee and sugar price has risen due to El Nino conditions in southern hemisphere. Metal prices stay weak as China increases its metal exports. Activity isn't too exciting in China and global industrial activity weakens. Energy prices have risen in recent months. Geopolitics pose a risk to further rise in crude. On the other hand, even if Middle Eastern situation should de-escalate sometime in future, Saudi's desire for a floor on crude price and US plan to build its petroleum reserves could limit the downside to crude. From the valuation perspective, commodity looks reasonably valued when compared to the equities and hence provides some margin of safety on the downside. Global equities have been falling for 3 months now. Rising yields makes the valuation unattractive and growth stays on a risky footing. Hence, unless Fed injects liquidity or the long end yield starts to fall low or China sees a material rebound, equities will face some kind of risk. Indian equities have lost some ground as well in October, but not as much as other countries. Valuations have corrected to a more reasonable level. However, given the worst in equities may still not be behind, cautiousness remains. We prefer large cap over small cap and focus on sector-wide diversification. Coming to the Indian fixed income market, Indian G-Sec has risen by some 15 basis points across the curve last month. Liquidity deterioration in the banking system has also led to a rise in overnight rates to 675 levels. After this rise, G-Sec valuation compared to history and equities look marginally attractive. While the spread vis-a-vis US has narrowed significantly, this could be a paradigm shift, and such compressed spreads could continue for the months to come. Higher yields help to take the duration exposure at the margin. However, we may still be some time away from a structural build-up to the duration in our portfolio. For India, we keep saying that the bar for any further rate hike is high, but equally challenging is the hurdle to bring about monetary easing. Global developments of upside risk to crude and high bond yields will keep RBI vigilant on the external account and rupee movements. Had it not been for the impending index inclusion for Indian bonds, rupee could have been on a bit shakier footing. Further, RBI is aware of strong government intervention to keep food and fuel inflation under check, which tells you that the upside risk to inflation remains, more so when general election is just a few months away. As such, bond moves could stay range bound in India. Signing off for this month. Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.